It's time for Yahoo Finance's Market Minute. Stocks are lower, on track for a fifth straight week of losses. Nike shares slipping as its latest results and guidance failed to instill confidence in the company's turnaround plans. Nike guiding for a steeper than expected drop in fourth quarter revenue, warning about external headwinds like waning consumer demand and tariff risks. FedEx under pressure after missing estimates in its third quarter and cutting its full year guidance. FedEx saying continued weakness and uncertainty in U.S. industrials is constraining demand. And Micron sinking here. It's after reporting margins below analyst expectations. Shares of the chip maker initially popped thanks to strong third quarter results and upbeat guidance driven by robust AI demand. That's your Yahoo Finance Market Minute. For more on what's trending on Yahoo Finance, scan the QR code below to track the best and worst performing stocks of the session.
Welcome to Wealth, everyone. I'm Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, the tools, the tips, and the tricks that you need to grow your money. Hey, on today's show, for our portfolio checkup, one strategist reveals why the biggest risk to long-term investors right now is missing out on a future rally. We're going to discuss that. And President Trump signed an executive order dismantling the Department of Education. We'll discuss whether or not it's really going away and what student loan borrowers should plan to do in the wake of uncertainty. Plus, it's travel week on Wealth. Ahead of the spring and summer travel seasons, we're talking about maximizing your travel credit cards and rewards. Stay tuned for that conversation coming up. But first, we take a look at some of the market action. 90 minutes into the trading day and stocks are falling to end the week. The potential implications of more tariffs weighing on investors right now. The S&P 500 on pace for its fifth straight losing week here. Joining me now, we've got Callie Cox, Ritholtz Wealth Management Chief Market Strategist. Callie, you say you're relying on the data right now to navigate the market. What data specifically are you watching?
Well, simply job market data, Brad. And it's really hard to simplify what an analyst looks at right now. But if you want a read on the economy, you have to look at the consumer. And when Americans are making money, they're spending money. So I'm watching initial jobless claims. I'm watching warn notices to see if layoffs are increasing. Because where we're at in the job market is that companies are hiring less. You know, if you're looking for a job, you could probably confirm that. But at the same time, they're not really firing people. We're in a bit of a frozen state right now.
And so it's so interesting because on one side, on the public sector side, you have this mindset of efficiency that's certainly rattling through and prompted by the Department of Government Efficiency. And then on the private sector side, you have the mindset of, okay, well, we'll just wait for attrition to happen. And if that doesn't happen, as is the case with Morgan Stanley most recently, then that's when they will use to, or as a reason code at least, to announce or look across some of where they need to trim. And so how are you going to be watching the data to see where those two things show up and if there is a trend that eventually gets made?
Well, let's split it how you just did, Brad. So the public sector obviously going through a lot right now. I'm guessing hiring in the federal government is effectively frozen. There's probably heightened attrition, and we are reading about layoffs there. I think people forget this, but the government sector is a huge part of the job market. The federal government employs about 3 million people. And we're still not sure about the size of these layoffs, although we're getting some indications right now that they could be large. So what you're getting from the public side is less hiring, which is critical because government was one of the only sectors that hired throughout the past year. You're also getting attrition and the chance that they're not filling those payrolls, and you're, potentially getting these layoffs that we're still trying to figure out the size on. On the private side, I think corporate America is in a good spot right now, especially bigger companies that are more profitable can be self-funding. So the fact that you're not seeing many layoffs on the private side is probably because companies feel okay, but that doesn't mean they'll be okay in the months ahead. And there's a lot of uncertainty. And so amid that uncertainty, what is the trade thesis that investors would be apt to keep in mind, even as they're looking across some of the pullbacks that we've seen in recent weeks? Well, I'm assuming I'm talking to a lot of long-term investors because this is a program about wealth. So I just want to remind people that you do have a lot of agency here with your portfolio. I mean, chances are you have years and decades ahead of you to build that wealth for retirement, for that nest egg that you're looking to build. So, if we see pullbacks here, especially if they're not accompanied by a breakdown in job market data, it's probably a good sign to put some money to work. We've seen corrections or 10% sell-offs in the S&P about once every couple of years over the past 7 decades. And if you remember that and are armed with the right context heading into a sell-off, you can feel confident investing more money in the market. Just stay defensive and stay on guard for risks.
And so what are some of the early indicators that investors who perhaps have some FOMO about missing out on the next rally or missing out on a dip buying opportunity, what are some of the indicators that they should be keeping tabs on to know that there is a more concerted or more conviction-led trade that the rest of the market is starting to rally around?
Well, I sound like a broken record, but again, job market data, economic data, signs that the economy is breaking down are probably signs that the stock market could head lower. Of course, nothing is a clear-cut rule of thumb in finance, but generally that's what we've seen over history. And again, I would look at job market data. I would listen to what companies are saying. And right now, even though corporate profits are growing at a pretty decent rate, we are hearing companies pull back on their optimism for the future. And we are seeing CEO confidence gauges fall as well. So the way that I would take that is, I wouldn't be too cavalier in this environment. It's a delicate dance at the moment. I would look towards those more defensive sectors in the market and just understand, what your time frame is and what you're invested in and how you can strive for that portfolio balance.
Callie, thanks so much for taking the time here with me today. Appreciate it.
Thanks for having me.
It's now time for some of today's trending tickers. You can scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. Joining me now, we got my good friend and market domination co-host, Julie Hyman. First, we got to talk about shares of Carnival Cruise Line. CCL is the ticker symbol out there, folks. They reported quarterly earnings, and we are seeing guidance for adjusted EBITDA in the second quarter, just missed estimates here. The cruise line also forecasting a slowdown in net yields in the second quarter. They saw net yields up 7.3% on an annual basis in Q1. They're projecting 4.4% growth in Q2 here. Shares trying to find their direction here. They were higher as we started talking about the story, and now they're flat, just barely to the downside.
Yeah, it's really interesting to see the stock kind of waver back and forth here because there was some good news in this report. The company, by all indications, said that bookings are still strong here. I thought that was interesting. The company talked about that there is sustained demand even for further out sailings. That was according to CEO Josh Weinstein in the statement. He said ticket sales for next year are at record levels as well. The company looking at advanced booked position for the remainder of the year that is strong. Pricing in constant currency at historical highs for each quarter. So they're seeing demand. They're seeing that pricing that's high. It just looks like it is perhaps that little bit of the EBITDA miss for its second quarter that maybe is responsible for this. We should mention the context also. The stock is down year to date, right? It's down about 16%. There's been a lot of concern about the cruise lines generally, both the consumer, but also the sort of noise that the administration has floated about changing the tax status for some of the cruise lines, most of which are not domiciled in the U.S., and of course their ships are not domiciled in the U.S. Most analysts don't necessarily take that seriously, but it is something that has affected sentiment surrounding some of these names.
Interesting. I've only been on a docked cruise liner before. So
And what'd you think?
I thought it was a large vessel.
I went on one cruise a very long time ago, and I got norovirus, unfortunately.
Oh my
But
goodness.
it was a decent experience otherwise.
All right, better cruise line experiences to come for both of us here. It's only up from here.
Yes.
All right, or at least out of the port. Next, FedEx is falling after cutting its full-year earnings forecast for a third consecutive quarter. Loop Capital is downgrading the stock after earnings to sell from hold. The analyst writes that the near-term outlook for the company isn't positive as the company faces macro risks, including tariffs. And the firm also says with economists increasing recession risk that FedEx is not a good recession stock. Shares down 9%.
Yeah, this is one, FedEx along with UPS are viewed as economic bellwethers, and they're very economically sensitive. And that is something that the company now is having to contend with here. So earnings per share this year are now going to be $18 to $18.60, $18.95 is what analysts had been estimating. And as you mentioned, this is not the first time they've cut the forecast. It's been happening here. They said revenue could be down slightly this year versus last year. And I thought Rick Patterson's note from Loop Capital was indeed interesting here. He said, like it or not, FedEx's brand is synonymous with global trade. So that's one issue. And he said, FedEx's thin express margins in its express business amplify the earnings hit whenever there's pressure on the top line, like if there is a recession, for example. So he says hopefully it won't come to that, but still he's cutting his rating on that to a sell, and the price target is now $221. And the company was asked, by the way, about tariffs directly on the call. Yep. And kind of said, we're going to manage around it. We're going to be as nimble as we can. Interestingly, they did not say they saw a pull forward effect. In other words, there's been this thinking that a lot of businesses are pre-ordering a lot of inventory to try to get ahead of the tariffs. And they said on the call there was only one customer that did that noticeably, and then they didn't like that they got stuck with all that inventory. So that's kind of interesting, but they kind of emphasized that they're going to try and be nimble with the tariffs and help their customers manage through it. So it's like so many things right now, it's kind of a wait and see situation.
Yeah, and it certainly impacted the guidance for the full year. I believe they brought that now to a range of $18 for the full year, the fiscal year. Top side, I think, is $18.60.
Yeah, exactly.
All right, so we're going to be watching FedEx very closely to see if they can hit on some of these markers. Julie, thanks so much.
Yeah, good to be here.
Coming up, everyone, President Trump signing an executive order aimed at dismantling the Department of Education. We are breaking down what that means for students and student loan borrowers after the break.
Today we take a very historic action that was 45 years in the making. In a few moments, I will sign an executive order to begin eliminating the Federal Department of Education once and for all.
That was President Trump on Thursday before signing an executive order to eliminate the Department of Education. The order comes just 1 week after the agency announced mass layoffs that would cut its workforce in half. Here with more is Jordan Weissmann, senior writer covering consumer news from Washington. Great to have you, Jordan. Just break this down for us and the significance of this all.
So one thing you have to realize is that Republicans have been talking about ending the Department of Education ever since Ronald Reagan, almost immediately after the department was created. Trump looks like he is making the most concerted effort yet to actually do it. And given what he has done to some other federal agencies and offices like the CFPB, USAID, this looks like it could be really serious. One very important thing to know, though, is that the Department of Education was created by Congress. It's written into law. It would take an act of Congress to actually eliminate it. So what Trump is doing is he has essentially told his education secretary, Linda McMahon, to take every legal step possible to get ready to shutter the department. What people expect to happen is that he is going to try and what they've said they are going to do is they are going to try and move as many of the department's responsibilities, things like student lending and Pell Grants, for instance, to other departments. They may try to change the way billions of dollars in aid to public schools is distributed, give that to another department, and then eliminate whatever isn't required by law. So they are preparing for a wind down, but it's unclear if they'll be able to actually shutter it.
And the timeline for this, it sounds like there would need to be legal proceedings. There's going to be a vote in Congress. What does that all kind of shake out like?
We don't know exactly. Is sort of the bottom line. There are a lot of known unknowns here, including the extent of his legal authority to do some of these things. That said, they've already started layoffs in motion. They've already, that proposal to cut the workforce in half, that's real. That is something they are attempting. It's always difficult to predict how long things will take to shake out in Washington because there are always lawsuits, and much of what Trump is planning to do could be litigated. That said, a lot of people are worried about what the impact on borrowers could be here, or what the impact on student borrowers could be here. If there really is an attempt to move the federal student aid office to another part of the government, if it's done wrong, it could be pretty disruptive. That system's very fragile. Moving a single loan between different servicers can lead to information being lost. Now, trying to imagine moving the entire $1.6 trillion portfolio. So there are a lot of nerves. There's not a lot of detail about what they are planning. So everyone's just kind of watching closely.
Jordan, thanks so much for continuing to track this for us. We'll be checking back in for sure.
Thank you for having me.
According to research by the College Investor, Americans have roughly $1.8 trillion in student loan debt, and the majority of that number is federal student loans serviced by the Department of Education. President Trump signed an executive order aiming to eliminate the department, and even if the plan doesn't go through, the Trump administration has laid off roughly half of the department's staff. That leaves tens of millions of borrowers wondering if this will impact their debt. Joining me now to break it all down, we've got Betsy Mayotte, who is the Institute of Student Loan Advisors president and founder. Betsy, thank you for taking the time, and it's good to see you again. So just first and foremost, would borrowers be impacted by the elimination of the Department of Education?
So the vast majority of the everyday work done on federal student loans is actually done by loan servicers and vendors. So, and as you mentioned, or your prior guest mentioned, the terms and conditions of the loans are set in statute and federal regulation. So most things would not impact borrowers. But of course, anytime you move a really big portfolio from one place to another, there could be delays.
And so what about on the front end of that? When you are applying for the loan, how does that process get changed?
That's a good question. So again, a lot of that is done by servicers, but the day after the Department of Ed did their big reduction in force last week, the FAFSA failed. And I actually just recently read that because of that, they're actually bringing back some of the people that they laid off last week to make sure that doesn't happen. So that's something we're definitely going to be watching.
Should federal borrowers be making any changes at this point?
That's a great question. And my short answer is no. People definitely should not be making panic decision based on a new headline or an executive order that gets signed. As your prior guest mentioned, these things can take a long time to shake out. We expect there to be lawsuits. So sort of like take a deep breath and keep yourself educated on what's going on.
And so as we're trying to help folks stay educated on this, President Trump also making changes to forgiveness plans. What should borrowers be preparing themselves for there?
They actually haven't made any changes to the forgiveness plans. Due to the SAVE litigation that was initiated under the last administration, some of the income-driven repayment plans are temporarily on hold, meaning you can't apply for them, but those will be coming back in the next month or two. There was an executive order signed around public service loan forgiveness, but it's questionable whether that is an executive order that's allowed under statute. And regardless, it just instructs the secretary to pursue potential new regulations around that program.
So more so just the initiation of legal proceedings to try and figure out whether or not the executive order is actually something that can be enforceable at this juncture.
That's right.
And so what should incoming students be aware of when they're signing up for loans right now? Do you think we'll see more universities following Harvard and eliminating tuition for some students under certain household income thresholds?
Well, I hope so. But, that's another really good question. One thing I am watching very closely is the budget reconciliation process, because I do think that has the potential, a big potential, to impact future students, such as restricting the amount that people can borrow or putting some risk sharing in place for colleges and universities around the student debt issue.
Betsy, thank you so much for taking the time here with us today.
My pleasure.
We're checking a quick stock to break. Shares of Boeing rising and shares of rival Lockheed Martin, they are falling right now after Reuters reported President Trump will award Boeing with a contract to build new jets for the U.S. Air Force. We're keeping an eye out for the official word from the president. Coming up, are you thinking of buying a home this year or planning to put yours on the market? We've got the tips ahead of this weekend's open houses. Stay tuned. Mortgage rates remain below 7% for the ninth straight week, but will that be enough to get potential home buyers off the sidelines? I want to bring in Jenna Stauffer, who is the Sotheby's International Realty Global Real Estate Advisor. Jenna, good to see you once again here. Thanks for joining. Will this unstick or at least alleviate some of the market here?
There are still going to be a lot of challenges in the housing market. I think there has to be things besides just lower rates to really get the market moving. Look, one of the big things that's happening in the market right now is there is a lot of economic uncertainty. We really have all the markets. They're in flux. You've got the bond market, stock market, the housing market. People don't like this uncertainty. They really want to feel financially secure before they enter the housing market, before they make one of the biggest investments in their life. So I think that that's something that we have to have happen is there's got to be more certainty and less volatility going on.
Certainly. And so what does the latest kind of roundup of data really tell you? And especially as we're thinking about next week economic data too, your expectations from home prices and new home sales?
Well, I think, again, the market is being defined by this economic uncertainty, but something that's also happening, we just got the latest read on existing home sale data, and that actually surprisingly had a jump in the month of February. So it was a 4.2% jump from where we were in January. So I think that does tell you that there are people that are tired of waiting on the sidelines. There's people that are tired of trying to time the market, and they're going ahead with decisions. Of course, I think in terms of, what happens with interest rates, what happens with the economy, there's just so many moving parts. We're in transition right now. So it's just really going to be dependent on the health of the economy to see what happens with new numbers that will be released.
From the buyers that are coming off the sidelines, are there keys to the purchase that you're hearing them continue to cite right now?
So I would say that something that the market is so localized. There are so many pockets of the country where it is turning into a buyer's market. It's becoming much more buyer friendly. So I think that there are buyers out there that are finding some opportunities. They're seeing homes that are sitting on the market for longer. They're seeing a lot of price drops happening. They're getting some great opportunities. And then, of course, in some pockets of the country, these markets are really geared towards sellers. Sellers have the upper hand, and these buyers are still up against a lot of competition. They do have less inventory in these markets, but something that has happened overall in the housing market is we have seen inventory levels. They actually have gone up from where they were last year, around 27.5%. So that is giving buyers more options.
So what are your tips for home sellers here, especially as we enter into the spring buying season and selling season?
Well, it's so important to know your market. You have to understand your market dynamics for buyers and for sellers. Sellers, they have to understand the value of their home. You do not want to price it too hard in these market conditions. With inventory levels picking up on a national level, that means, of course, buyers have more choices. They can take a little bit longer. And I think that really pressures sellers to price their home correctly. And then, of course, if you're a seller, have your home ready to go. Have everything in place, have repairs done. That is something that buyers are looking for, homes where they don't have to be putting cash into it, because look, buyers are up against so many affordability constraints. So the last thing that they want to do after paying a high price for a home, after having to deal with an elevated interest rate, pay for these higher taxes, insurance, is put a bunch of money into the house.
We talked a little bit about what you were seeing in Florida and in the Keys last time we spoke. I wonder, have you noticed any changes in migration? Do you think eliminating property taxes will drive more buying in the state? What are some of the factors at play in your region?
Yeah, well, the property tax thing, that's definitely very interesting. We have to see how that all unfolds. And look, Florida does like to lead the way with things. And I would have to say that considering that Florida has been one of the fastest growing states, we have really low unemployment here. We have such strong job growth. You have to give our administration down here some credit. I think they do know what they're doing. But by even talking about eliminating property taxes, I think that shows just how much strain strain there are on buyers in Florida, in my market too. And I think, unfortunately, for some buyers, they're under too much strain. They can't afford to purchase here. Even homeowners are under a lot of strain. So if these homeowners are under strain, I think you're seeing them migrate to, of course, places that are more affordable.
Jenna, thank you for taking the time here with us today.
Thank you.
A programming note, everyone. On today's episode of Warrior Money, Patrick and Dan speak to Kenny Polcari about investing insights for veterans.
I always use this analogy. When Bloomingdale's puts the suit on sale and they mark it down 20%, you go and you buy 3 of them because how can you leave it on a counter?
Yeah, go get it.
Meanwhile, Apple's on sale by 20% and you want to sell it.
Yeah.
It doesn't make any sense. It's Apple. It's not like it's some micro nano cap company. Okay, I would say this is a micro nano cap company. You don't want to be there. But if you've got a portfolio that you've designed that's well designed, that represents the biggest names in the industries that you want to be in, and then we have a little bit of anxiety. You got to kind of look at the names you like. You look at the ones that are being most affected. You got to make sure that the reason that they're selling off is nothing other than kind of the cyclical market versus any specific company news.
You can watch episodes of Warrior Money every Friday at 12:30 p.m. Eastern Time on Yahoo Finance or wherever you get your podcasts. A new survey from J.D. Power shows homeowners insurance property claims have become a pain point for consumers. The study finding that the number of catastrophic events, premium increases, and slow repair cycle times have constrained customer satisfaction with these claims processes. Here to dig into the survey, we've got Mark Garrett, J.D. Power Director of Insurance Intelligence. Mark, the second I saw J.D. Power publish this, we had to discuss this further, especially considering some of the most recent catastrophic events impacting families and households and when they're ultimately seeing some of those pressures alleviated through the claims process. What are you seeing, broad strokes here?
Yeah, broad strokes, unfortunately, it was another really tough year for the industry. The last time we reported on this data, the industry was just coming out of a record-breaking number of extreme weather events, right? So it was the all-time record. They've been tracking this data for 40 years. And, 2023 set the record for 28 events. Last year, we just had 27 events. So right there's no signs of this really slowing down. So we're just seeing that this is just a stressful time for the industry, right? Just to get the resources, not only from the insurance companies, but getting the contractors, the materials available, being responsive to customers. We see all of these things just starting to strain. That's why we're seeing the process slow down. This is the longest we've seen the cycle times being reported. So for customers to get fully paid for their claim, we're seeing about 45 days. We've never seen the process take this long. And as you had mentioned, one thing that kind of sets the backdrop to this is a lot of customers are entering this having a premium increase, right? So they know, kind of top of mind, they know that their policy is renewed. Sometimes they're seeing 20, 30% rate increases, and they're getting a lot of media attention around this too. So what we're finding is I think they're almost starting in a hold to some degree when you're having this process, because you're already a little skeptical about, okay, why are my rates increasing? You go and have this claim and maybe have some challenges. Maybe there's, your coverage isn't quite working the way you thought it would. We know there's generally just a literacy issue around insurance. Do people really understand, their coverage and how it's going to work? And then you go into a process like this and have a couple issues of, maybe you're not hearing back quickly from the carrier, or it's taken a while. And then we really see that it's pulling down the overall satisfaction for the industry. And particularly in the areas really hard hit. So like the central states in the country had a lot of this volatile weather, a lot of repeated events happening. And that's that really key area where carriers have a lot of exposures in that middle of the country. Those carriers saw some really kind of sharp declines in our results this year.
Yeah, well, of course, claims and insurance, the fine print around that is usually a good bedtime read if you're looking for a good nap. But unfortunately, it's all very important, especially when you consider what you were laying out a moment ago, which is the number of billion-dollar disasters as measured by the National Oceanic and Atmospheric Administration, NOAA, combined with the insurability of certain regions and the claims processes taking longer here. What would you describe? How would you define the state of insurance right now?
I mean, it's been in a pretty tough spot, I'd say, on the home side. The home side of the business, if you look at it from the combined ratio, like what the carriers are paying out versus the money they're bringing in, it has been negative now. They have lost money. The estimates are about 105 combined ratio, so they're losing 5 cents of every dollar they bring in. That's the 24 calendar year results, but it's been that way for 5 years in a row and 6 of the last 7 years. So this catastrophic weather, I mean, it is at a crisis point now where it is a pretty consistent, happening on the home side that they are losing money on that business, right? They're paying out way more in claims. The loss ratio, what they're exactly paying out in claims, we just achieved like the highest point in the last 20 years, just 2 years ago.
You know, I wonder, because I want to give folks some actionable tips here. We do advice for people who are trying to set up their insurance claims, their insurability on perhaps a property or anything that they own here. What are some of your top reminders?
I mean, a good reminder, a good starting point is always, know your policy, review your policy, know what's covered, what's going to have some limitations or some partial coverage, know what's just excluded, so you're more informed kind of entering this process. That's always, I think, one clear starting point there. And there's some things that, customers are responsible for as they kind of approach this process, right? It's have as much information as you can ready to go, right? Have stuff documented, have, whether it's receipts, get multiple, estimates on things. We always say that's always a good tip, right? Get multiple estimates, because just, as you would on any kind of work you're getting done, compare some prices, you get an understanding, make sure you're getting a good quote there. Some of the tips you have up here, right? Have a contractor, if that's going to help things, have them actually meet with you and the adjuster so they can have those conversations about it. We talked about the estimates here. Kind of worst case, if things aren't, another point we make about knowing your policy is some policies can have an appraisal clause. So if you are having kind of a dispute over how much money they're going to pay, you may opt out into this other process that has third-party people get involved and actually help determine the ultimately kind of the value of what they're going to cover. Those are a couple things. We also see digital tools can help. So a lot of carriers are offering, hey, submit photos that can help move things along. You can have the option of using digital tools to itemize your contents and, capture some of the loss around the home. So a lot of those things can also help kind of speed the process along. So we certainly advocate use those tools as they're available to help move things along.
Mark, thanks so much for taking the time here with us.
Yeah, thank you. Appreciate it.
Coming up, building generational wealth. We'll talk about the ins and outs of starting and growing your investing journey. President Trump announcing Boeing will build the U.S.'s next generation fighter jet, the F-47. Trump saying the new jet will be built during his administration. There were competing bids between Boeing and Lockheed Martin. You're seeing shares of the defense companies Boeing rising. Lockheed is in the red right now. This comes 2 years after the Air Force made a formal request for proposals, those RFPs, to develop a next-generation jet that can fly in tandem with drones. The Air Force plans to spend up to $16 billion on the project through 2028. That's according to the 2025 budget announced last year. This contract will likely be a critical test for Boeing, which has been under pressure the last couple of years. President Trump and Elon Musk have both slammed Boeing in the past for how long it's taking to build the new Air Force One jet. Musk met with Secretary Hegseth this morning at the Pentagon, discussing the innovation, efficiencies, and smarter production. Boeing shares are up on the news by about 4%. $124 trillion is projected to change hands through 2048, with women in younger generations expected to receive $47 trillion of it. So we thought it was a good time to talk about building generational wealth that you too could one day pass on to your children and children's children as well. Joining me now on set, we've got back with us Ashley Fox, CEO of Empify. Good to see you. Let's talk about this. And Empify, of course, a fintech firm focusing on financial education and empowerment. As you think about this great wealth transfer and how much of that is set to really get passed down to women, what are some of the early steps that can be taken to really put the framework together for generational wealth building?
I think now, specifically at this time, with so much uncertainty, this is the time to learn. This is the time to invest. This is the time where things are on sale, some of the biggest and best companies. So I would recommend getting your brokerage accounts open, investing in some of the biggest and best companies that have survived a lot of economic downturns, and really focusing on building the wealth and understanding that if you are going to buy the product or service that the company creates, why not own a piece of that company too?
Absolutely. Okay, so when you think about the top tips for investing, even amid some of the volatility that we've seen right now, with a mindset for generational wealth building or long-term success here, what are you instructing folks to keep in mind?
Don't panic, breathe, and go after it. So play offense. And so I truly believe that some of the biggest and best wealth is created during an economic downturn. So this is a time where things are on sale. You're considering buying some of the best companies and not operating out of fear, but playing offense, operating out of abundance, knowing that the market has its downturns, bounces back over time. And if you're focusing on that long-term investment portfolio, don't let your emotions cloud your logical judgment.
What if you say, and your emotions tell you and your bank account tells you, I don't have a lot of money to be doing this right now. How can you get started even with a low base of capital to deploy?
Nowadays, some of the biggest and best brokerage accounts allow you to buy fractional shares. So I always tell people, if you have at least $5, you can invest in the stock market, and you can $5 your way to building that $1 million portfolio. So start with what you can, but make a commitment to invest every 2 weeks in paying yourself and putting your money to work for you.
What are some of the common pitfalls that you see along the way of building out wealth for yourself that can eventually be passed on generationally as well?
I think definitely fear. We allow ourselves, we think we don't have enough, we think we need a lot of money to invest. And I think when it comes to building wealth for yourself and your family, have a family conversation. Let's start talking about it at the dinner table. Let's start talking about what we're doing and how we're doing it, but not let fear or the mistakes that you've made in the past dictate your financial future.
You also talk about ignoring financial education. How can you make sure that you're staying educated along the way?
So I always tell people Monday, Wednesday, Friday, pick an article in the news. When you think about building wealth and learning the language of money, just like any new language, you have to be fluent. You have to speak it, you have to read it, you have to be around people who are constantly talking about it. So find an article that has an attractive headline and just immerse yourself in the language. Start to Google certain things. Become very curious, because I think a lot of headlines, especially now, trigger us. It causes fear. But if you see a company that you use as their product or service, if you see a company or a title that interests you, go deeper. And challenge yourself to say, I'm going to build wealth regardless. I know I might not have grown up with money. I might not have a lot of money, but I am going to create the financial legacy that my family deserves. And my fear and my doubt and worry is not more important than the financial legacy I'm going to build for my family.
Right now, and perhaps circular ending to our conversation here, because it's where we started off with the pullback that we've seen most recently in markets. And there are a lot of traders that are trying to figure out, okay, what is a viable long-term growth investment opportunity versus one that I'm just making in a trade based on FOMO? How do you kind of delineate between the two?
Well, first, looking at some of the biggest and best companies that have survived previous economic downturns. Think about where companies were trading at before the pandemic even happened. And understanding that, one, you want to make sure the company has enough cash to take care of their bills, especially if you look at dividend-paying investments that are paying out that consistent income every 90 days. Do they have enough money to pay their bills, pay you, and take care of their debt obligations? So really focusing on the large organizations that have survived the economic downturns in the past, and also listen to their earnings calls. What are they telling you? How are they adjusting and adapting to what's going on in the markets and within the economic system as well, because they work for you, right? So I challenge everybody to pay attention to the earnings calls, pay attention to the news, and really focus on the direction the company says they want to go as a result of the economic changes.
Just replace your podcast listening with an earnings call. Why not? Why not? Especially if you're invested. Yes. Ashley, good to see you. Thanks for joining us in studio again.
Thank you.
Coming up, everyone, we give you the go-to guide for maximizing your travel credit rewards and those card rewards that you've got just piling up. That's next on Wealth. Spring travel season is underway, and we want to give you a foolproof guide to maximizing credit card rewards to help pay for your next trip. Joining me now, an expert on this, Clint Henderson, managing editor at The Points Guide. So Clint, good to have you in here in the studio with us. How does one pick the best travel card for their needs?
So it's going to really depend on what airport you're flying from, what airline you like to fly. But that's why I like to tell people, just get one of the premium credit cards with a transferable currency. So Amex, Chase, Capital One, Bilt. They all transfer to various partners. It's going to give you a lot more flexibility. And these cards have huge annual fees, but if you maximize them, you can more than make up for the cost of the annual fee. So in the case of American Express, $700. There's speculation it could go up even higher, but they have so many credits, travel credits that you can get, Uber credits, restaurant credits, all kinds of interesting things that you can do to offset that annual fee.
What cards do you recommend for frequent travelers out there?
So I would say the American Express Platinum is my go-to. Even though it's outrageously expensive. The Chase Sapphire Preferred is a basic card, $95 a year, but it gives you a $50 hotel credit. It gives you a big sign-up bonus, which is the way you really build up those miles and points. The Chase Sapphire Reserve is a higher-end card that has travel credits as well, up to $300. And then the the Capital One Venture card, another one with big travel credits that you can maximize. And so these annual fees can be scary to people, but a lot of times they are worth it.
And so how many cards should the average consumer have out there?
So I would say pick your favorite airline, the one that you fly the most. Get their co-branded credit card, because that gives you free bags, priority boarding, and sometimes some other perks, and a big sign-up bonus. And then get one of the cards with a transferable currency. So don't be crazy like me and have 27 credit cards, but maybe 2 to 3 to start. And then when you get a little more advanced, if you really want to get those big points balances, you got to open multiple cards. But there's all kinds of tricks going from there.
So speaking of the tricks here, what is the best way to rack up and redeem points and for free and discounted travel? Because that's what we really want. We want to travel for free.
Absolutely. And I think the best way to do that is to get those sign-up bonuses. But for most people, I would say start with a card where you're putting all your spending that has a currency like membership rewards from American Express that transfers to literally 18 partners. So whether that's Hyatt Hotels or whether that's Air France Flying Blue, because that's when you really maximize it, when you're using other carriers. You're finding the award that you want, that business class seat to Europe, and then you're transferring the currency over to book the actual trip.
How do you recommend somebody keep track of their points?
So I keep a spreadsheet,
okay.
But there is services. The Points Guy app has a way to track all your balances. Really good way to keep track of it. There's other products out there that offer tracking services, but I just keep a simple Google sheet. It keeps it basic. I just recommended this to a friend. I said, just put the cards you have, the balances, and it gives you an idea of where you're at.
Okay, so if you have a spreadsheet, I imagine you have more than 5 credit cards then.
27.
27?
27.
Over time?
Over time, and here's some other tricks around that. So not everyone's gonna be obsessive like me, but I have huge balances because of that. But if you have a card, you get a big sign-up bonus. Don't close the account. Downgrade it to a no annual fee if you don't wanna pay the annual fee the next year. So you've got that sign-up bonus. Downgrade it to a no annual fee version, then you're not paying a lot of annual fees. I am, because I know I can maximize those cards. So I make sure I'm getting every single statement credit. I'm using the travel credits, using those rideshare credits and the Resi credits and all those things. But you want to keep track of that and make sure you're doing that.
How do you know when to put a credit card on the chopping block?
So if it's not giving you benefits, if you're not earning your annual fee back every year, then it's time to downgrade that card and not necessarily close it, because that can hurt your credit score. So even though I have 27 credit cards, I have excellent credit because I've kept those accounts open. It looks like I have a lot of credit available. I have a low credit utilization, and so you're really maximizing your credit score that way.
Interesting. How do you avoid common credit card fees and pitfalls?
So the first thing I would say is don't ever carry a balance. That's tip number one, because any reward you're getting from carrying a balance is going to be outweighed by the interest you're paying. So you want to be able to pay that card off in full every month. If you can't do that, don't even get in the game. Then it's not even worth it. Keep track of what credits are available on that card and just make sure you send a reminder to yourself once a month to use the credit. Just make sure you're getting the annual fees worth of value from that card every year.
All right, personal favorite question here, and I only have 30 seconds.
Yeah.
How do you know when it's time to buy the travel insurance? When it's time to click that button when you're booking a trip to protect it and get the insurance on top of what you're already paying?
Don't ever buy that travel insurance.
Really?
No, if you book your trip with one of the premium credit cards I've been hammering on, they include up to medical evacuation on that card, so you don't need additional insurance. unless you're a skydiver or a deep sea diver or doing action sports, then sometimes you'll need a supplemental coverage. But use a premium card that you know has the insurance you want on it. Medical evacuation, not all cards offer that.
None of the activities that I do count as action sports. Clint, thanks so much for taking the time here with us.
Anytime.
Oh my goodness, color me shocked. Well, before you start planning that spring break trip, you should make sure your finances are in order. Friend of the show, host of the Financial Freestyle podcast, Ross Mack, joins me now with some tips to clean up your finances. Hey, Ross.
Hey, Brad, how you doing? Well, one, I want to say, if you're golfing with me, that might be considered an extreme sport because I might have to yell out 4.
Well, I certainly hope that we can brush up on our swing skills before getting out there. All right, so what are the tips for cleaning up your finances before a trip?
Yeah, without a doubt. One, I think it's important that people understand, listen, everything is affordable so as long as you've budgeted for it throughout the course of the year, right? And so when it comes to, whether it's spring break trips with the family or the summer break coming up, the idea is step one, you should have already been planning for this the year before, the few months leading up to it. And the first thing is to talk about is a sinking fund. The idea is you're literally just working backwards over the course of the year or months leading up to it by saving periodically so that once that time comes, you already have the money for it, right? And I think, the other things that you want to clean up is it doesn't make sense to go on a vacation if you don't have a fully funded emergency fund, right? You do not want to be pulling money, right? Robbing Peter to pay Paul. You don't want to be pulling money from your emergency fund just to pay for your family vacation. And another thing, working backwards, right? It's like, you do not want to be carrying credit card debt. The gentleman before me was saying this as well. You don't want to be carrying high interest credit card debt before traveling. You're paying an average of 25%. You got to ask yourself, how fun was that? And another thing, you do not want to put your vacation on a credit card if you don't have the money to pay for it. Those are just a few steps that I would recommend.
Ross, thanks so much. And you can see more from Ross Mack. Tune in to the Financial Freestyle podcast every Monday, 12 p.m. Eastern Time on Yahoo Finance or wherever you get your podcasts. Let's do a quick final check of the markets as we're taking a look at the major averages here on the day. The Dow, the S&P 500, and the NASDAQ are all fractionally lower as of right now. We're taking a look at the deepest percentage-based declines on the S&P 500, down about 0.75%. And on a point basis, you've got the Dow down 260 points. That equates to about 0.6%. Same on a percentage basis for the NASDAQ. That's it for Wealth, everyone. I'm Brad Smith. Thank you for watching. Stay tuned. Market Domination comes your way 3 p.m. Eastern Time. They'll count you down to and through the market close.